Hook. I was staring at the ETF flow data 3 weeks ago, and something didn't add up. Bitcoin had pulled back about 11% from its local high. Retail sentiment was ugly. Social media was calling it a breakdown. And yet, every single day that week, spot Bitcoin ETFs were absorbing between 1,800 and 2,400 BTC net, quietly, consistently, with almost no fanfare. Meanwhile, the on-chain data showed long-term holder supply ticking up, not down. And the mNAV premiums on the largest Bitcoin treasury stocks had already compressed to levels we hadn't seen in 4 months. Most people saw a correction. The data was describing an accumulation phase. By the end of this video, you'll know exactly how to read those 5 institutional signals yourself. With a framework you can run every single week before making any Bitcoin allocation decision. This isn't theory. These are the specific thresholds and patterns I use, built from months of tracking spot ETF custody figures, on-chain cohort data, and treasury stock premiums together as one unified picture. Stay with me. This might be the most useful 9 minutes you spend today. Section 1. Why ETF flows are the new order. Let's start with why ETF flows matter so much more now than they did even 18 months ago. Before spot Bitcoin ETFs existed in the US, institutional demand was largely invisible at the margin. You could see Grayscale's premium or discount. You could look at CME futures positioning, but the actual buying was opaque. That changed completely. As of mid-2026, US-listed spot Bitcoin ETFs collectively custody somewhere north of 1.1 million BTC. To put that in perspective, that's over 5% of the entire Bitcoin supply, held in structures that must report daily net flows. That reporting requirement is the gift. It means we now have a near real-time window into what institutional capital is actually doing, not what it's saying in a quarterly letter. Here's the key mental model. Treat daily ETF net flows the way a traditional equity analyst would treat order flow imbalance. Sustained positive net flows, even modest ones, across multiple consecutive days, signal that institutional buyers are absorbing supply at current prices. They're not reacting to price. They're setting a floor. The mistake most people make is looking at a single day's number. A $300 million inflow day sounds impressive in a headline, but one day proves nothing. What you're looking for is the streak and the size relative to new Bitcoin issuance. At roughly 450 BTC mined per day post-halving, even a modest 1,000 BTC net ETF inflow represents more than twice daily supply being pulled off the market. Do that for 10 consecutive trading days, and you have a structural supply squeeze building in real time. Section 2. The 3 flow thresholds that actually matter. I track 3 specific flow thresholds, and each one tells you something different about conviction. Threshold 1, 500 to 1,000 BTC net daily inflow. This is noise floor to mild accumulation, not a signal on its own. Context dependent. If it persists for more than 7 consecutive trading days, it starts to matter. Threshold 2, 1,000 to 2,500 BTC net daily inflow. This is meaningful institutional accumulation. Historically, when we've seen this sustained for 10 or more trading days, BTC has posted a 20% plus move within the following 60 days in 4 of the last 5 occurrences since ETF launch. That's not a guarantee. It's a pattern worth waiting. Threshold 3. Anything above 3,000 BTC net daily inflow sustained for 5+ days. This is an institutional sprint. These events are rare, but they've consistently marked either the early innings of a major leg up or, and this is important, the final euphoric flush before a sharp correction if they coincide with price already up 40% plus in a short window. Context matters enormously at this threshold. The directional signal isn't just inflows. Outflows matter equally. Net outflows sustained above 1,500 BTC per day for a week or more are a yellow flag. Above 2,500 BTC per day for 2 weeks is a red flag that institutional holders are repositioning, not necessarily selling Bitcoin long term, but reducing ETF exposure, which creates a real near-term price headwind. Write these thresholds down. They're your first filter before you do anything else. Section 3. On-chain data, confirming what ETFs can't tell you. ETF flows tell you what institutions are doing today.